What's up, homies? Welcome to another episode of the Homies Real Estate Podcast. It's your host, Anthony.
I'm Angel.
I'm a realtor.
I'm a lender.
And together we got a really great podcast for you. The most recent data, the Consumer Price Index, just came out. This is August 10th, so the data for July came out. Did inflation go up? Did it go down? We're going to cover it in this podcast. And then its impact on rents, on housing, on mortgage rates, and then some advice for you buyers and sellers heading into the upcoming months. So with that said, Angel, let's just go ahead and go over the most recent Consumer Price Index.
Let's do it.
So the Consumer Price Index climbed to 8.5% in the year compared through July. So it was 9.1 the month before. It's a bigger slowdown than most economists expected. Most economists were expecting about 8.7, 8.8%. And again, it was 8.5%. So I'm not saying we peaked last month, but we may have. One of the biggest things that led to this drop was gas prices. So gas prices were about $5 in June, and now they're starting to fall back towards $4 a gallon in July. So I'm sure you're starting to see that as you fuel up your car. One thing though that we did start to see is an increase in rent and an increase in food. So it was higher this month, or I guess in July, than it was in June. So that's a bit of a concern. But overall, the Consumer Price Index reflects 8.5%. We beat expectations of 8.7, 8.8%. So it's something to celebrate. Hopefully we hit a peak. Angel, what caught your attention about the most recent Consumer Price Index?
One, I think we're all happy how you said gas prices coming down, right?
Yeah.
Hopefully in California we see an average of under $5. We're not there yet, but we're in SoCal, but hopefully soon. But with that being said, obviously this podcast is about the importance of home ownership, right?
Yes.
And how we think buying a home is truly still part of that American dream, and just I think everyone should really push towards that. And the reason we say that is because as we did the podcast last month showing home prices have come down over the last month, rents haven't, right? And that's something I think we've both preached all the time is rents are never going to come down. It's really rare when rents come down, even whether that's on a month-to-month basis. Definitely year over year, they're never going to be coming down. I don't know the data on that. I'm not 100% sure that's been the case historically, but I would make that assumption that it hasn't, right? So, for you people who think that renting, or that home, that's a bad time to buy a house, you do have to keep this in mind with rents, that rents are still going up. Yeah, so I think that's my main takeaway from this.
Yeah. So for you homies, thanks Andrew for that takeaway. For you homies, I think a really good idea would be to watch this podcast on YouTube, just because there's about 5 charts that I'm going to be adding here that makes it a lot easier to dissect. One of those charts is what inflation has looked like since 1965, right? And the most recent data shows that after stripping out food and fuel costs to get a sense of the underlying price pressures, prices climbed by 5.2% through July. So again, that's more or less good news, right? So we're starting to see inflation, really start to decrease. It just really the food that increased recently, and rent has also increased recently, which we are going to put a chart here for you to look at, where is that month over month increase and decrease at. But Angel, let's go ahead and talk about the Fed funds rate.
Yeah, so any of you that do follow me on my Instagram, I do my midweek mortgage update every week. So I do announce these in both June and July. The Feds have increased, have done 2 increase to the Fed fund rate by 75 basis points each month, June and July, right? How that has affected the rates, believe it or not, rates have actually gotten better since this news, right? Yep. Remember, Fed fund rate, that does not directly correlate or directly affect interest rates, right? So that's good news, right? As far as what we should be expecting in the future when it comes to the Fed fund rate, they are signaling in September another jump. It could potentially still be a 75 basis point jump. For those of you who don't know, that is a huge jump. That is a very, very big jump. And for it to be one in June, July, and September, that is I don't know if that's like an historic record, but that is 3 big jumps consecutively, right? With that being said, Fed Chair Jerome Powell did state until he feels like inflation is where it needs to be, or until they feel like they have control of inflation, they are going to take these aggressive rate hikes, right?
Yes.
So we could potentially see it. I would not be surprised if in September we have another 75 basis points Fed fund rate hike, right? With that being said, to wrap it all together, is we want to see, more importantly, when it comes to mortgages, how that affects mortgage rates, right? Does that mean that we continue to see lower interest rates, or are rates going to come back up, right? So the market's been pretty volatile lately in regards to rates are increasing and decreasing like crazy every day, nothing significantly, but some days there is a significant jump and some days there's a significant drop, right? And I'm sure it has to do with this Fed fund rate and then the volatility in the market right now.
Yes. And I think that's Angel. I think that's a point that is very important. So the Fed funds rate indirectly impacts mortgage rates. Just because we've been seeing 75 basis point increases, or 0.75% of a percentage point increase, doesn't mean that that's going to impact mortgage rates by that 0.75%.
Correct.
Right. More recently, we've seen mortgage rates decrease from, mid 5s to into the 4s sometimes. Right. They had it actually even peaked into the 6s. And right now, like Angel mentioned, it's volatile, which could work against you or for you. That's why it's important to be pre-approved ahead of time. And that's why it's important that you stay up to date with your lender if you're in that process, so that you lock in the rate when it's volatile toward the downside. So you can lock in a rate potentially in the 4s as opposed to in the 5s, right?
And just to give you an example, I don't know, I might have explained this in the last podcast, but I'll state the story again. I had a client, not this past Friday, but the Friday before that, so 2 Fridays ago, who was working on getting pre-approved. I gave him an estimate. The rate I don't remember exactly the rate. I want to say it was around, I just remember the interest rate. The average 30-year fixed rate was 5% that day, right? On Monday, we had to give an update, and I believe that was a day rates. They jumped quite a bit that day, and they went up to 5.25. Right. That was just from Friday to Monday, right? It's just such a drastic jump. So it is very important, like Anthony said, to be in contact with your lender, so you're making sure that your pre-approval is still as good to the amount that you originally got qualified for.
Yes, absolutely. Now, homies, let's talk about rent. So rents are increasing. As you can see here on the consumer price index, right? Since last month, rents have increased 0.7%. So if you annualize that, multiply that by 12, that's 8.4% annually. That's a lot, right? If you think about it, if you have a $1,000 rent and you increase it by 8.4%, that's $84. Is that 84? No.
For what? For you said what?
$1,000 rent.
Yeah.
Times
$84.
Yeah.
I believe.
That's $84. We got to get the calculator out. Let me see. Let's get the calculator out, Angel.
Yeah, let's make sure. My iPad doesn't have a calculator. If you know who has an iPad, I don't know why they do that. They just,
Oh my goodness. Okay. Let me do this for us real quick.
I'm pretty sure it's $84. I'm almost positive, but let's just make sure. All right, I have this iPad.
No, it's $84. Well, we had to make sure the math was done correctly. We're both relatively good at math, but I don't know why that one was a difficult one. It's $84. I did the math already. So if you think about it, for every $1,000 in rent that you're paying, that's an $84 increase, right? So if you paid $2,000, now that's $168, right?
Yeah.
So that's a lot of an increase in just 1 year.
Yep.
So again, rents are increasing, but at the same time that rents are increasing, home prices are decreasing. We just did the most recent market data for Los Angeles County, for Orange County, and we pulled all the data for most of the cities and counties in California. And I can tell you that across the board, prices are decreasing, which is great news for buyers, right? Because now as rents are increasing, prices are decreasing. So, and there's less buyer demand, and sellers are more willing to negotiate, and homes are sitting on the market longer. So what that means in all is that you're able to get a much better deal than you would have been able to in the last 2 years. And it's starting to make more and more sense as rents continue to increase to purchase in the face of this inflationary environment that we're in, right? So,
and I just one thing to mention too, you know, the stats we go over for home prices is LA County, right? As far as that increase in rents, that's nationwide. So potentially we don't have the numbers just for LA County, but that could potentially be higher as well than 0.7, right? So just something I wanted to mention.
Yeah, that's a great point, Angel. I'm glad that you mentioned that. So there's one thing that I do want to say right now, because there is this window of opportunity right now, and I don't want anyone to squander it trying to wait for a real estate bottom, thinking, oh, if I wait until next year, I think I can get a home for $30,000, $40,000 less than I can get right now. Now, what's likely going to happen is inflation will peak. It might have just peaked last month, because again, the reading is 9.1 last month. It is 8.5 this month. So it might have already peaked. We're not even sure yet. But we'll get, as we start to get more months in, we'll get that confirmed whether 9.1 in June was our peak. But if we actually have that peak, what's likely going to happen is interest rates will drop back down, right, to stimulate the economy. And that's also going to drop down mortgage rates. That's going to bring the pool of buyers in who have been waiting because they got priced out back into the market. And then the buyer frenzy may resume. And you don't want to purchase then if you don't have to, because it's more expensive, takes more time, and it's more frustrating. So what I'm trying to say is, don't try to time a real estate bottom. Just know that this is a really good window right now to purchase, right? And even if you purchase, let's just say in September, and in December prices end up being $20,000, $30,000 less, if you plan to stay in that home for 10 plus years, let's just say 10 years, your home is going to be worth more, right? And I actually pulled the data for Los Angeles County. And, you know, guess what the Los Angeles County sales price was in July 2012?
Los Angeles County sales price in July 2012. I mean, what's the average? Like 8 something right now. I would say like 370, 380.
Yeah, so that's a great guess. So in Los Angeles County, the median sales price using a rolling 12 months of data, so it cuts out like big variation, was $325,000.
Oh, shoot.
In July 2022, that's $850,000. So it's more than doubled in 10 years. Now, I looked at various cities, and basically any city you name, prices have likely doubled or more in the last 10 years. So if you're trying to time a bottom, right, to save $20,000, $30,000 when your home is likely going to double over the course of 10 years, like don't shoot yourself in the foot trying to wait and then miss out on that opportunity to purchase, right? Because that's a lot of equity that you're leaving on the door.
Yeah.
Now,
and I think one thing to mention too, because 2020, 2021 was historic numbers for appreciation, right? And that's something that, to be honest, we're definitely not going to see consistently. But if we just look from 2012 to 2017, we're looking at about over $200,000 in appreciation over those 5 years. And then from 2017 to 2022, we're looking about 310. So, I mean, it's still, I mean, again, the last 2 years were probably where that extra 100K came from, but still that appreciation over just from the first 5 years to the last 5 years, they're actually pretty similar, I feel, considering how much homes appreciated just in the last 2 years.
Yeah. So that's a great point, Angel. Actually, when you pull the data and you use a rolling 12 months of data, the line tends to be a little bit more linear, actually, over 2012 to 2022. It does have a little bit more of an inflection going upwards because there was higher appreciation the last 2 years, but nonetheless, like it still was around 8 to 10% year over year appreciation from 2012 to 2022, right? But like Angel mentioned earlier, so let's just look at the last 5 years of data, right? So from July 2017 to July 2022, Los Angeles County median sales price 5 years ago in January 2017 was $540,000. Now in July 2022, $850,000. Now, again, this is using a rolling 12 months of data to cut out variation, but that's an increase, like Angel mentioned, of $310,000, right? So even if you plan to stay at a home for 5 years, like you're looking at, $300,000 plus to save, maybe $20,000, $30,000 if prices, drop and you're trying to time a bottom, right? So don't try to time a bottom. It's always impossible. Just find the right time to purchase for yourself that you can afford the monthly payment, knowing that, hey, I can actually refinance this rate in the future and drop down my payment. And if you're going in with, let's just call it 5-10%, right? And interest rates do drop down. Now you have a bigger pool of buyers who are qualifying for more, who are purchasing the home across the street for $100,000 more. Bam, you just earn $100,000 of equity. You can now refinance, get rid of that mortgage insurance, and also drop your rate. So you get a double win in that instance. So homies, I don't know how many of you are on our website, but if you go to theluevanosgroup.com/appreciation, I have the appreciation data for almost every single city and county in Southern California. And it's very insightful. It lets you know, okay, like here's where home appreciation is the highest. Here's where it's the lowest. I can tell you that out of all the charts that I pulled, I don't think there was one that had negative appreciation the last 5 years, right? So home prices, yes, they tend to increase over time. So yeah, that's kind of my spiel right there. I mean, there's a real opportunity here for you buyers, and I just don't want anyone to squander it trying to wait for a real estate bottom. Rents are increasing, prices are decreasing. Mortgage rates have been decreasing slightly recently, but it is volatile, and there is that window of opportunity. Angel, what do you have to say about that?
No, I think Anthony hit everything on the mark to wrap up this podcast. And the main thing, right? Rents are increasing, homes are decreasing, less competition right now. And I don't expect this competition to last. I think eventually the market's gonna. It's still it's still is a buyer's market right now. Seller's market. It's not necessarily a walk in the park for buyers. But any of you buyers out there 4 or 5 months ago know how crazy it was, even 2-3 months ago. So take advantage of the opportunity right now. Make it happen. And yeah, stop paying rent, stop paying somebody else's mortgage, right? Let's get you to pay your own mortgage.
Yes.
That's the goal that's the goal of this podcast at the end of the day, is to educate people on that.
Absolutely. Help you build wealth. We're here for that. We're here to help you out. So with that said, homies, Angel, where can we find you at?
At Your Mortgage Angel on Instagram.
At Your Mortgage Angel on Instagram. You know where to find us. At the Luevanos Group. If you haven't already, please subscribe to our YouTube channel. Follow us. If you have any feedback, we would love to hear it. We like to make this podcast as fruitful for you as possible. And with that said, homies, peace out.
Peace. Hey, homies, it's Angel from the Homies Real Estate Podcast. This podcast contains our opinions and is for educational purposes only. It does not guarantee any projections and should not serve as the basis for any purchase or sale in real estate.